So differentiating between like a slowing economy and actually a negative growth economy, I think we can see, and we probably will see, some negative growth this quarter for the first quarter of this year. I mean, that is what parts of the Fed have forecast, to have negative growth this particular quarter. And that's a direct result from all of the uncertainties that are happening right now and the inability of companies to sort of move forward with decisions or putting down payments for growth or whatever it might be. That doesn't mean that the full year is going to be recessionary. That just means that we could see quarters of negative growth mixed with quarters of positive growth, which could in effect lead us to not that 1.7% number. It could lead us to a 1% number overall, or 1.2% number overall. So we still have an economy that's sort of stumbling along, not necessarily full on recessionary for the year, but potentially recessionary for a quarter or two, but on average just stagnating while inflation is rising. So you get what economists refer to as stagflation. It just basically, it's stagnant economy, inflation rising, which is all that combination of words is. And that is something that we can definitely see. And in terms of what Bassett said and what the Treasury Department has said, it's valid to note, and it's logical to say that if we do have uncertainty and we do have some slowdowns and we know that the cost of debt's high for the consumer on up through the government, if nothing sort of gives in that scenario, and if rates kind of stay where they are and tariff uncertainty continues, etc., that President Trump has said this, there will be potential pain along the way. And we're seeing the beginnings of that, not like the beginnings like 0.0, starting beginning, but, sort of the early stages of what we could see from the standpoint of pain and a slowdown. Whether it's a full-on recession, again, it depends on your definition of recession. We could see a quarter two negative growth. I think net it's more stagflation right now. And it depends on the sector. Some sectors are doing better than others and will do better than others because they're part of a sort of larger trend picture. And that could be the energy sector. It could be the mining sector because of the latest executive order that the administration just put out on critical minerals. There could be those sectors that outperform. So it doesn't mean everything's uniform, which is why as an investor, you have to be particular. But it's not like there's one black and white sign of recession. There's not one black and white sign of growth in one area. It's really a combination of all of these factors. Debt to GDP is like still 124 or so percent. Debt relative to the deficit, I think that's going to be a really tall order. I wouldn't say, given what we're seeing right now, it's possible. I mean, what would have to happen is there would have to be certainty about tariffs, wherever they're going to stay or not stay. And a lot of them cancel each other out. So there will have to be negotiations that if the steel and aluminum tariffs at 25%, but processing is happening in Canada or some aluminum is coming from another country, that ultimately things net out. That has to happen to create a stable environment under which companies can make decisions. So that has to happen in order for us to have some better equanimity between debt and the deficit. And we have to have growth. So we actually have to be investing in certain sectors and invest in such a way that the growth outpaces whatever inflationary pressures the spending in those areas could do. A lot of people sort of mix up this idea of, well, if you invest, or if the government invests, or the private sector invests, or they invest together in any particular sector, let's just call it mining processing, just as a very mini subsector. We focus a lot at Prinsights on real assets, like mined assets, and processing, which right now is predominantly done in China. But let's say that changes, that costs money. And so there has to be a firm decision that, well, that might cost money, and that might have a slight inflationary impact on money, but the net result should be more growth. And the growth should outpace the inflation, so it's not stagflation. And that can help to reduce the deficit by growing the economy around it, as opposed to simply, sort of cutting some costs, which won't necessarily get us there, sort of a drop in the bucket. I'll give you an example. We just wrote this piece on how defense is sort of moving from some of the U.S. expenditures, which are still massive, to Europe, which is increasing its defense. Well, the Department of Defense Secretary Economist said that he found, or that DOGE found, $480 million worth of potential cuts to defense contracts. Well, compare that to a $770 billion budget. I mean, any of us can do that math if we just think of it in our own pocketbook terms. It's not a lot. So that doesn't really decrease a deficit. That's like sort of a very, very minute potential adjustment, but it doesn't shrink a deficit. Yeah, so we are looking at a sort of massive trend, and a lot of reasons for it, towards Europe upping its level of defense spending and also manufacturing and production of defense-related equipment, materials, and so forth. And some of that acceleration is the direct result of what the Trump administration has been doing in terms of reducing its funding or its help towards Ukraine, requiring or asking President Trump has for NATO to be more of a potential from 2% of GDP to 5% of GDP. That hasn't happened, but there is a sort of process by which some of what's happening in the US has an impact on what's happening in Europe. And on the other hand, Europe has been increasing its defense budget anyway, even before this point, over the last few years since this episode of the Ukraine war escalated in 2022. Most recently, there is a proposal for an 150 billion euro fund for basically local defense companies and lending into those growth areas. And that's just one of many proposals that are just coming up now. So there's a lot of money that's going into fortifying defense in Europe, in the UK, and even US defense companies are like sort of trying to stake more claim in that part of the world, as are European companies. And so we've been following a particular company. We're doing a full analysis in our paid issue on this week coming out that really kind of circles into all of that, where the contracts are coming, where the funding's coming, this big trend of defense movement in funding and in geopolitical just repositioning. So this is something that's not going to go away. It's something that's had a number of catalysts, Ukraine war and the recent White House decisions, but it's definitely something in play that's going to be a trend for a longer term, and it's just accelerating now. So that movement between these markets has to do with where there seems to be more certainty, which is in Europe. We did a piece on this, what's in Europe and some of the emerging market countries. It's in sort of Pan-Asia outside of China a little bit, but also, countries like Vietnam, Indonesia, and so forth that are sort of growing economically relative to the US. So if we just look at Europe and Eastern Europe, there is this higher growth of investment funds, not necessarily all of their economies, because they're in balance. Some economies better than others. Spain is better than Germany and so forth, but there's been an influx of investor funds, not just from the US, but also from, for example, China and Pan-Asia because of the uncertainty over US tariffs, how that's depreciated the dollar most recently. US markets, they're a bit less balanced in that, we know the sort of Magnificent Seven is a big component of the main markets, and so if something happens in one of those, there tends to be a multiplying effect, and that's part of the correction is along with the uncertainty, whereas some of the European indices, the DAX, the FTSE are a bit more diversified in terms of the sizes of the companies that comprise them. And so that really plays a big role, as well as their more solid location and the general pivot of the world to being a bit more reconstructing trade agreements and investment and direct funding agreements relative to uncertainty in what's happening in the US and our policies relative to other countries. I think the uncertainty that the S&P is struggling under right now has to do with what's going on with tariffs for the most part. I mean, yes, a slowing economy a little bit, but we've certainly seen markets outperform the economy, and our market outperform the economy. That was definitely what happened when rates were lower and the Fed was in easing mode. We can definitely see the economy slowing and a market going up. I think what's impacted this market, and we compounded by, discussing whether the economy is going to grow or not, in the media and so forth, is that we have policy uncertainty at this moment, and that does have an overhang, and it has like a knee-jerk reaction within the US market, which is part of the reason we've seen this correction. And you put on top of that the uncertainty over the Fed, as we're discussing. Is it going to be 50 basis points like they said? Is it going to be 75 or 100 because of slower growth and other issues like we believe? And or is it going to be in between? Is it going to be none of that if inflation spikes, right? So there's still that uncertainty. I think in general there's an expectation of 2 to 3 cuts to an average somewhere between 50 and 75 basis points, but that hasn't been sort of substantiated by the Fed. And markets like certainty. Markets want tariffs to be sorted out. Markets want, 100 basis point cut in the Fed. And if those two things happen for however they do, whenever they do, that's going to light a fire under the US market. It might keep the dollar still lower because rates might come down in terms of a currency perspective. But that's one of the reasons I don't see a massive downfall of the S&P to head the end of the year. We could end down relative to the end of last year, but I don't see sort of that other leg going. If the tariff uncertainty gets sorted out within the next quarter. I mean, if it doesn't, we have to readdress this. But to the extent that a lot of what's on the table gets resolved or at least substantiated, I think that will go a long way. If growth is still slowing and the Fed comes in and cuts more, I think that will go a long way. So I think this quarter is going to be very pivotal. We're going to see in the meantime earnings come in that could be, most likely will be negative, in terms of overall relative to projections from last year, because we have had this slowing quarter. So we're going to be bumpy this quarter. But if you're talking year end, I don't see it being 20% down versus last year. So what we've seen in gold, obviously touching over 3,000, and we've been targeting that sort of a year or two ago to reach that level over this period, is that gold is receiving so many sort of hugs from the investor and the central bank and the retail community because of its staying power, because of its solidity, because there's so many reasons why gold has been sort of that touchstone over these uncertain periods. It does act as an inflationary hedge, it does act as a diversifier against the US dollar as countries trade more and more with each other and sort of less in dollar terms. It does act as a wealth preservation, generational preservation. And you mentioned I was just in Austria. What's interesting too is, certainly for Europeans anyway, is that it grows without a tax hit. So you can basically, for example, buy solid gold coins from the Austrian mint, keep them at the Austrian mint and have no tax implications. So for Europeans, there's that benefit as well. We have seen more inflows into both ETFs and physical purchasing of gold for that reason. We have seen more purchasing gold, of course, by the central banks. I don't think this diversification away from the dollar is going to stop. There's no particular reason for that, given just where we are at in the world and more pull towards outside of US trading. And so even though the dollar will still be the dominant reserve currency, it's not going to go away. There's a lot of shifting, and gold's the recipient of all of that. It sort of is welcoming all of that volatility and all of that uncertainty and all of that change and desire to preserve wealth and preserve sovereignty and to preserve diversification of currency as one asset. That's what we're seeing. And so I think gold could reach 5,000 by the end of this administration, not because necessarily what goes on any one of these factors, but that's because that's where all of these factors are indicating we can go. It's also where, if we look at an analysis of these and other kinds of factors going back in time over the last 20 years or so, we've seen the biggest bumps in gold happen where there's a confluence of all these sorts of events. And right now we're looking at that confluence, but on steroids. And so that's why I think we're going to see that eventual push. And we are seeing it. Gold's not volatile. It's just trending upward where it belongs to be because of all these factors. Yeah, so they used to own, going into 2018, about $1.2 trillion worth of U.S. treasuries. And today, they own about $750 billion. So to an extent, some of that selling happened into the 2018 tariffs on expectations of them, and just in general, China pivoting to trading with other countries. Not just because of tariffs, just because they're growing in their sovereignty. Some of that started in the wake of the financial crisis, but it just accelerated through these periods. And so now we're seeing that they basically have repositioned their own book of assets, the People's Bank of China, to have far less treasuries and far more gold. That trend, both of those two things, are continuing to grow. In other words, the decline in treasuries as an overall percentage of their book and an increase in gold, which is still very small, still under 5% of their book, but an increase in gold to offset or to be that hedge to fiat currencies where they do have a stockpile in physical gold to back up what they have in terms of more liquid reserves. And so that's going to, I think, continue as well.